Good morning and welcome to the 2020 results presentation of Liberty 2 Degrees. 2020 was a challenging year for L2D, for our people, our industry, the country and humankind across the world. I thought that video explained it better than any words ever could. That said, 2020 is done and we now shift our sights forward to 2021 with hope and holding the belief that we can move forward every day towards a period of recovery. When I was the SAPOA president in 2014, the theme that I chose for my presidency was, "Don't forget the real in real estate." The real estate industry, especially retail, has taken severe strain and has never felt more real. Ensuring a careful balance between supporting all our stakeholders and protecting our business will be one of the things that we have to continue to do, even if the outcome will never be exactly perfect. However, the only way we can tackle the challenges is with empathy and by using the information and insights that we have to make the best decisions to move us forward. If you have any question during the presentation, please type them in the space provided on the screen. Gareth will assist us with a Q&A at the end of the presentation. Summarizing a year like 2020 is best explained by the things that were top of mind for us as a management team. Safe environments for our people, our customers, tenants, and the miracle workers in our malls. This was our number one priority. We've seen strong recovery in Q4 as restrictions eased and customers returned. Our iconic destinations continue to house leading retailers that are now supplemented by new experiential and interesting brands. Creating a sustainable rental base that we can grow from has been our team's focus. Our strong balance sheet position is a key competitive advantage. Over the last 4 years since our listing, our prudent capital management strategy served us well, and supported by the quality of our assets, we believe that is what delivers value today and allows us to pay a distribution of 32.33 cents per share for the year and maintain our 100% payout ratio. Safety first remains a key priority in all our environments. We were the first mall owner in South Africa to receive international COVID-19 certification for our entire portfolio by the Safe Asset Group. This was supported by our extensive communication and visual campaign to keep people safe. At first, we opened up booms for ease of parking entrance and exit, and then added different payment opportunities and additional contactless payment solutions. Our teams wanted to make a difference, so we partnered with a One People Fund and our customers who were using our parking and collected 1.25 million to provide food parcels to those in our communities that needed it, as you saw on the video. Curbside pickups and click and collect facilities became the norm. And as restaurants could start opening again, we provided some additional outdoor space to assist them. We also created campaigns to support their business recovery. Bringing customers back into our environment safely remains a key ingredient in determining the success of our efforts. Without customers, all the efforts of our tenants and our teams in the malls will be wasted. All the research and feedback before and during the pandemic supports our thinking that the quality of the customer experience makes the difference as to whether they return to the mall or not. 2020 was a year with 4 parts to it. The portfolio had a solid start to the year. The foot count was trending positively above 2019 for Jan and Feb. The foot count and turnover experienced a sharp decline after the first confirmed case in South Africa and the resultant lockdown announcement in March. Through level 5 and 4, our assets were hit particularly hard. The third quarter was a slow reset where more customers returned, but spend was slow to pick up. Then we saw a really strong recovery in quarter 4, with feet returning to 79% of what it was the previous year. For the full year, 70% of people returned to our malls. Turnover, on the other hand, recovered to 91% in December. Dwell times are increasing because people have to queue outside the shops. You just have to walk down the escalator at Sandton City to see that in our Diamond Walk. Spend per head is therefore up because people are frequenting the shops less and buying more when they are there. When looking at comparing the real impact of 2020, we believe that turnover growth is a better measure than trading density growth that we would normally use, as turnover growth indicates the actual spend not adjusted for anything. For December, the portfolio generated turnover of 91% of the December 2019 levels, as I said. Looking at the whole of 2020, the portfolio had about 78% of the turnover that it had in 2019. Popular categories included electronics, home and interior, watches, sunglasses stores, and of course, luxury brands. Sandton displayed exceptional trading over the festive season, with turnover almost flat versus the previous year, which illustrates Sandton's ability to recover after the more severe lockdown restrictions. The turnover performance of 2020 tells the story of a customer that rewarded themselves with retail therapy when holidays and travel were not an option. Eastgate, as well as the other regional centres, Midlands Mall and Promenade, are also seeing good improvement in trading. And Botshabelo remained resilient during the pandemic, continuing to generate positive turnover growth throughout the year. The top 4 categories that contributed 65% to the portfolio's turnover illustrates the progressive recovery over the 4 quarters. The greatest impact was felt in the second quarter of the year, where all non-essential retail, including luxury, apparel, and apartment stores, were closed for April due to the hard lockdown. We have many international tenants and they could not get the correct stock levels either. Also, due to travel restrictions, a number of tenants that benefit from travel were severely impacted. Luxury brands grew by 27.7% year on year, even though the shops were closed for almost 2 months in the hard lockdown. That is comparing 10 months to 12 months the previous year, and still showed that growth. While the apparel and department store categories are driven by discretionary spend and are not quite above their 2019 turnover levels yet, they have performed gradually better during the year, with certain retailers within the categories performing well. Turnover was supported by the grocery category, even though the portfolio is weighted towards larger format centres as opposed to smaller convenience retail. Grocery and supermarkets managed to grow by 13.2% over the year. That is consistent to what we've seen the retailers themselves reported on. The relevance of our quality super regional centres in optimal locations, complemented by an appropriate and diverse tenant mix, addresses customer needs and support the customer experience. So the spend was not only captured in 2020 by neighbourhood and convenience malls. You would need to visit a few small centres to get your medicine, your groceries, your stationery and your clothing. You don't find them all in one place. Add to that the new trend of extreme casualization of fashion that Avio reported on last week. You would also want to visit an athleisure store. Well, you can only get that all done at a bigger mall. You also don't get luxury brands anywhere else, with ultra luxury being unique to Sandton City. So no, super regionals and regionals are not dead. The good quality, iconic super regionals in prime locations are still presenting excellent investment value. The engagements between tenants and ourselves remain key in ensuring we understand their priorities and they understand ours. The focus in the relationship shifted to a partnership that can best serve the future together in answering to customer needs. The initial focus was on the Q2 hard lockdown, where most support were provided to the most heavily impacted tenants. There were difficult times during those negotiations, but these were concluded to create an environment where tenants could continue to trade and we could keep the mall occupancies up in order to serve customers. Collections have also begun to improve as more rental relief negotiations have been concluded and the regulations eased. The collections have improved from 38% in April to 135% in December. This resulted in the 115% for the last quarter of the year on net collections, or if you look at it on gross collections, that is 120%. We will engage with the retailers in a virtual roadshow later this year, where we will share strategic priorities and develop a better understanding of their plans. Our tenant engagement platform, where we can share valuable insights, will also form part of our Smart Spaces rollout plan for 2021. Our team has undertaken good leasing during the year, with a total of 177,000 square meters, or just under 19% of the portfolio expiring in 2020. Almost 71% were concluded at the end of 2020. The largest renewal was the Sandton City Convention Centre that was concluded on a management agreement basis until we know where that market settles, but it remains closed due to COVID. In retail, we concluded 34,500 square meters of renewals for the year at a negative reversion rate of 32%. With many retailers struggling to survive the pandemic, the retention rate remained good at just over 86%. Notwithstanding this difficult trading environment, 64 new tenants, just under 15,000 square meters, were introduced into the centre over the year. Whilst reversions were high, these renewals only represent a small portion of our portfolio at 3.6%. This illustrates the trade-off in a difficult year between keeping tenants and striking the right sustainable rental levels. For offices, we concluded 32,800 square meters of renewals at a negative 26% reversion, 3.5% of the portfolio, and that was largely driven by Melrose Arch, carrying 67% of the renewals. The Melrose precinct was hardest hit with 9,000 square meters of office tenants vacating and looking for alternative workspace solutions. Our office retention ratio was 72.3%. The retail leasing that was conducted over the 4 quarters of 2020 illustrates that leasing continued during the pandemic, with new deals picking up in quarter 3 and 4. The slide captures some of the new tenancies that have joined our retail environments, thus enhancing the shopping experience for our customers. The SAPOA retail benchmark saw the occupancy rate decrease to 93.1% in quarter 3. Our retail occupancy, whilst above the benchmark, decreased to 95.3% at the end of the year. When taking the new deals that have been concluded in the first few weeks of this year into account, largely driven by the leasing activity at Eastgate, our retail occupancy increases to 96.8%. Each of our assets have quality anchor tenants. This is as a result of deliberate tenant mix strategies and key relationships and the quality locations and standards of our centers. Many retailers still have their number 1 and number 2 stores in our portfolio. Our office vacancy was 87.6% at the end of the year. If we take the pre-lets into account, where the tenants haven't moved in yet, it takes it to 87.9%, and this remains above the SAPOA benchmark of 86.7%. Melrose Arch was impacted again by large tenants such as Arab vacating and Stanlib downsizing. The office sector remains challenged as the environment settles into new ways of working. When considering the leasing achieved thus far in 2021, our overall occupancy improves from 93.3% in December to 94.1%. This is only a mere 1% down from where we were before the pandemic. Spaces don't fill themselves. It takes very hard work and dedication from our teams on the ground to ensure the work gets done. Thank you to every member of our property management team and JHIR management who give their best for us every day. At the beginning of 2020, we made a commitment to have all our malls Green Star rated by the Green Building Council of South Africa. I am very proud to announce that we didn't allow COVID-19 to stand in our way, and we have indeed achieved this industry-first milestone in South Africa to have our retail portfolio that we co-own with Liberty all certified. Achieving high environmental ratings reduces exposure to commercial risk and asset obsolescence by ensuring our assets are future ready. And true to form, the iconic Sandton City precinct achieved a world-leading 6-star rating, the first for retail on the African continent. Eastgate, Nelson Mandela Square, Promenade and Midlands all received 5-star ratings and Boccabello a 4-star rating. With great support from Ecocentric, the green building consultancy that guided the asset's green certification, our mall teams, and the relentless drive from our Good Spaces team, this achievement demonstrates L2D's environmental leadership, stewardship, and social responsibility in this space. Most importantly, it provides assurance that we are future-proofing our assets that will lead to long-term financial performance. ESG remains key in underpinning our strategy through the various building blocks that support the good that we do. It was a priority in 2020 to ensure that our mall environments had the highest standards of hygiene, care, and security. In addition to the COVID-19 compliance certification by the Safe Asset Group, all our malls received Gold Excellence status for overall operational performance, and Sandton achieved a world-leading rating for security against 180 international assets. Our commitment to our net zero 2030 target remains a focus area for the business. Eastgate and Midlands now both have solar plants with 1 megawatt each. We saved 60 million litres of water in 2020, and we were the first landlord to join the SA Plastics Pact. We continue to invest in the communities where we operate, and our Create Tomorrow campaign made a big difference in the lives of people in 2020. We continue to invest in our assets to maintain their quality and drive future growth. Our operational CapEx programs focus on maintaining operational standards, health and safety initiatives, and technical and facilities improvements. A key part of our future growth strategy lies in unlocking value on the rooftop parking areas of our large assets. Our teams are working on various initiatives to support this, which also include the net zero initiatives. Part of the master plan rollout is our investment in digital capabilities and enhancements. These initiatives are all integrated and form part of our growth strategy for the future. Jose and his team worked endlessly over the last few weeks to get results out 7 weeks after year end. I appreciate the commercial and strategic awareness and their thinking about the future that goes into delivering these results. I now hand over to Jose to share the financial overview.
Morning everyone, welcome to our 2020 results presentation. As you will note from our income statement, our net property income for the year is down 317 million rand compared to the prior year. The two largest components of the decline is our portion of discounts effected on total rental due of about 112 million rand, to which I'll give some further insight later on in the presentation. Additionally, our credit loss provisions have increased by about 48 million rand. The increase in credit loss provisions is driven by a substantial increase in the arrears position in our debtors book as at year end, as well as more punitive loss ratios being assumed on the collectible debt based on the current environment. Outside of the credit provisioning and the rental discounts, we were impacted by lower income from the hospitality assets, including the convention centre. These assets were closed or operating in a care and maintenance environment for most of last year. The net impact of what was expected for these assets versus what was actually achieved is about 35 million rand in our portion of the portfolio. I'll speak to other judgment areas in our financial statements a bit later, but since we are on the hotels, I'd like to deal with them here. You'll recall that in the prior year, we classified the hotels as investment property. For purposes of the current set of results, this remains the case. What we have agreed with the operator was that the lease we have in place, or at least the revenue side thereof, will remain in abeyance until the hotels are allowed to trade and travel bans are lifted, and operations essentially return to normal. At this stage, it is our view that this is a temporary situation, which is part of the judgment calls we have made, and the accounting classification remains as it was before. We have incurred losses this year based on lower utilization of the assets. Parking income is down, in-mall activation and advertising income is largely gone. Going into the hard lockdown in March last year, there were a number of stores in fit-out or planned fit-out or vacant spaces that subsequently was delayed in being fulfilled or in some cases did not materialize. Collectively, these items cost us about 41 million rand over the course of 2020. Given the trading environment and uncertainty in forecasting lease renewals during the period were under pressure, and we suffered some negative reversions with further downward pressure expected in the 2021 year. The fees we earned from the unlisted Liberty property portfolio was impacted negatively by the decrease in valuations primarily at June of last year, and this had impacted us by 8.6 million rand. On the expense side, our property operating expenses is up by 16 million rand. This includes municipal charges being up by 19.5 million rand and some offset being provided by lower property management fees given lower collections of rentals. Expense growth outside of municipal charges is well contained. Of necessity, we have had additional cleaning and security charges this past year, but these were not exorbitant in context of the greater scheme of things. And further detail is provided in the annexure to this investor presentation. It remains concerning that rates and municipal charges continue to track ahead of inflation. Cost savings that we've had due to lower utilization of water and electricity are largely offset by lower recoveries of those charges from our tenants. Our fair value movements for the year relate to the write-down of the properties, mark to market on our interest rate hedges of about 44 million rand, and the write-down of our investment in Edcon of 17.5 million rand. We are currently about 82% hedged as far as interest rates are concerned. So we have had the benefit of lower interest rates on the unhedged component of our debt. An increase in debt utilization at the start of the year was offset by proceeds of the sale of the Centric City offices during the course of the year. I would now like to discuss some of the areas of judgment that we used in preparing our annual financial statements. As most would be aware, there are a number of judgments management have to make in preparing the financial statements. For these results, the key areas were valuations, accounting for the rental discounts provided, the classification of the hotels as investment property, and the provisioning we have made for further rental discounts and credit loss provisions. I'll discuss the valuations in a bit. The arrangement we have made with respect to the hotels is a temporary one, and we have thus continued to classify them as investment property. Where discounts given on leases affected rental payments in arrears, these were not classified as lease modifications, and this was the classification for the vast majority of the arrangements we have entered with our tenants. For a small category of tenants, most notably restaurants and fast food outlets, we made arrangements that affected their rental payments on a forward-looking basis, with most of these arrangements expiring at the end of the first quarter of 2021. For accounting purposes, this latter component of leases are treated as lease modifications, effectively meaning that the old leases are treated as having been ended and the new leases starting on the day of ending the old lease. This would have impacted the straight lining recorded in the income statement. But overall, this was a small component of our leases and it didn't have a material impact on the income shown on the face of the income statement. The extra provisioning we have made for credit losses and additional rental discounts are not deductible in the 2020 year from an income tax perspective, and consequentially create timing differences between when the impact goes to the income statement from an accounting versus tax perspective. Given that we expect to be profitable going forward, we have created a deferred tax asset on these timing differences that are likely to be reversed in 2021. The net result hereof affords us the ability to pay a distribution of 32.33 cents per share, effectively distributing all of our distributable earnings for the 2020 year. Our approach to providing commercial support to our tenants focused on the sustainability of their businesses and in turn making sure our environments remain welcoming, operational and safe. Various factors were considered, including our interpretation of their break-even positions and the contribution they make to our assets. In context of the bigger picture, we also had a role to play, especially given that many of the smaller businesses in our portfolio had been our partners for many years. The total co-owned portfolio provided discounts to tenants in excess of 300 million rand for the year 2020. L2D's effective share hereof was 112 million rand. 71 million rand hereof having been contracted by the end of the year and a further 40 million rand currently still under implementation. You will see from the breakdown provided in the investor presentation that 73% of the benefits we provided went to unlisted traders, restaurants and fast food tenants and SMMEs, where we hope it made the most meaningful impact. In addition to supporting our tenants, these measures were necessary to protect our own business. Finding the balance between enforcing a lease and risking a vacancy is not an easy one, but the benefits we have seen is retention and vacancies that are likely better now than what would otherwise have been the case. And as we conclude these arrangements, we have also seen an improvement in our collection rates. The notable movements on our balance sheet compared to the prior year is the portfolio valuation adjustment and to further point out that the additional provisions we have made for credit losses are offset against the accounts receivable balance and not shown as a separate credit on the balance sheet. We do have 500 million of term debt coming up for renewal in October, and this portion of our term debt facilities has been recorded as a current liability from being shown as non-current in the prior period. We have provided a breakdown here, a portfolio breakdown to provide context to the makeup of the GLA in the portfolio, as well as the source of income in the portfolio. Notably, 84% of our income comes from the retail portfolio, which only accounts for 65% of the GLA. As you will also see, the hotel's contribution, although small in context of the bigger portfolio, has suffered a significant deterioration in 2020, going from 3.2% contribution in value in the prior year, from 3.5% to 3.2% in the current year. Our property values were written down by about 1.7 billion rand during the year. Most of the write-downs occurred at the mid-year valuations. After capital additions of about 69 million rand, the value adjustment is around 16.3% compared to the prior year values. The entire portfolio is independently valued twice annually, and the main drivers of the valuation adjustment is more conservative assumptions in the forecast period for reversions, rental growth, and the periods required to let vacant space. After taking into account the write-down in property values, the write-off of our investment in Edgon, and the interest rate hedge mark-to-market, the dividend paid in 2020, our net asset value per share has decreased to R7.60. Our loan-to-value ratio at 20.5% remains healthy, especially in context of the asset write-downs we have had. These valuations are, however, appropriate in context of the environment and the type of assets we have. Our interest cover ratio of 3.9 times is 3.9 times, and we currently have about 1.75 billion in debt. The maturity profile of our debt and interest rate hedges are on the short end, but these will extend when we refinance 500 million of our debt facilities in the third quarter of this year. There is additional data provided in the annexure to the presentation that provides additional context to the financial results. I would now like to hand back to Amelia for the conclusion.
Thank you very much, Jose. With remaining restrictions in place, the current vaccine rollout outlook, and the looming third wave around the corner, we have very realistic expectations for 2021. But we are encouraged by the recovery we saw since in the last quarter of the year. It is important for us that we maintain focus and move forward every day. We can't keep on looking back. At the end of last year, we communicated our new ABC of Rebuilding for Growth. This intense asset management drive and operational strategy is led by Jonathan and the team in a very focused manner. Everyone that has dealt with them know that they are passionate about what they are doing in coming up with the right solutions. Our assets are in excellent hands. Agility remains key in the way the teams think, understanding the environment and responding quickly. The new ways of working have been opening opportunities to drive efficiencies. We also very much look forward to moving into our new home at Nelson Mandela Square in the next few months, and we hope that it will be a true example of how the future of work will look like. In the end, property remains centered in a few fundamentals that have not changed. The focus is on doing these really well and continuing to do so. Our precinct-focused strategy and strategic building block execution, coupled with the master plan rollouts, are key to creating the new communities of merged environments that are different from the way they were yesterday. We are building new micro-communities rather than just managing retail, offices, and hotels. Of course, this remains underpinned by our financial focus on our balance sheet and a sharp eye on our costs. Given the uncertainty regarding the duration of restrictions decided by government, the impact of the current economic environment, and how it relates to LTD's business, we will not be providing earnings guidance for 2021. Looking forward, we see encouraging prospects for a further recovery emerging over the year as the vaccine rollout gets traction and economic recovery starts happening. Although we understand that it will take time and it will be a long road to full recovery, we won't see 2019 levels happening again in 2021 or even 2022. We also firmly believe customers will again seek out our unrivaled asset experiences. We are confident in the quality of our assets and the enduring strength of the LTD business and team. My sincere appreciation to the board of L2D, who continues to support and guide us in every way. I remain immensely proud and grateful for the people of L2D and the teams in our malls. Our outstanding team showed true resilience and continuing to work tirelessly to help us, our tenants, and our communities handle this unprecedented situation with empathy. We have the strength of a truly diverse team that is taking the necessary measures to address all challenges in the best possible manner and strategically position L2D for the future. We have delivered on our immediate and operational and financial priorities in a tough year. Now, we remain committed on the journey to become the leading South African precinct-focused, retail-centered REIT, combining strong property, retail, and digital fundamentals and sustainable growth potential over time. Thank you for your support and for joining our call today. We will now take some questions, and Gareth is going to help us facilitate those.
Thanks, Amelia. I'm going to read out the questions that are coming through on the chat. The first one's from Daniel King, and he's asking what accounts for the upgrade in your DPS from November's guidance, and what was so much better than our initial expectation? I think that one's for Jose.
I think there are primarily two reasons. One, in the middle of last year, and I guess in the third quarter, we had expected to make greater provisions for credit losses and to see how these negotiations with tenants would ultimately pan out. What subsequently transpired was a better experience than initially anticipated, and therefore the initial trend of tenants not paying at all and withholding their rentals and starting a process with them was to some extent averted compared to what the expectation was at that point in time.
Thanks. The next question on the chat is asking, in the disclosure for department stores trading, does this include Woolworths, and which other tenants are included in that number?
We can provide a break. The department stores would be the department stores that would normally be classified under the classification as it is by MSCI, and yes, it does include Woolworths in that number.
Thanks, Amelia. I think another one for you from Joan Miller. What do you ascribe the exceptional strong turnover growth in luxury brands to, and can you please single out a few specific Diamond Walk tenants that have done particularly well?
I think if you've been to Sandton City over the last few months, I don't have to tell you that Louis Vuitton and Gucci have achieved excellent results if you just judge by the queues that are standing outside of the stores. This has been driven by pent-up demand, people that have not been able to travel overseas and rewarding themselves with luxury goods. We attended last week a presentation by Kevin Lings, the stand-up economist, that spoke about how well luxury cars over R1 million has done in 2020. And that very much is the same thing that we see in the Diamond Walk. Handbags not quite R1 million, but if you want to reward yourself with some luxury items, Sandton is the only place where you can get it.
Thank you. The next question is, are the municipal charges expected to decline following the write-down in the direct assets?
No, I think the valuations that we have for fair market value of these assets follow a different valuation process than what the municipality follows for their valuations. So we don't expect a decline in the municipal charges. What we have seen is in one or two of the metros, they have kept the rate per rand steady over the last year, call it that. But overall, we expect to continue to see municipal charges outstripping inflation.
The next question is from Charles Bowles, and the question is, please can you provide some additional clarity on Convention Centre? What was the previous leasing arrangement? How has this changed, and what is the rent effect?
At the moment, the convention centre, along with the hotels, have been closed for the large majority of last year. I think as confidence ultimately returns, we will reopen 2 conventions. There has been some minimal usage, but this has largely just contributed to offsetting some cost rather than providing a sustainable income. I think what we have agreed with the operator, Tsogo, is that the convention centre lease did come up for renewal last year. We had provided for an expected reversion on that lease in any event in its prior valuations, but we had not renewed that lease and instead entered an interim arrangement to look after the asset in a care and maintenance environment until we see how the return of international travel and, I guess, restrictions going away, as well as people becoming more confident in the business environment and for attending conventions comes back, and then we'll re-engage the operator for that asset.
Thank you. The next question is from Paul Duncan. When you quote rental discounts of 112 million, is this a net or a gross rent number? Do you still collect operating charges from those tenants?
That's on the gross number. So it's effectively what discount we give the tenant on the gross billing to themselves.
Next question is from Peter Kromberg. How does L2D plan to refinance the maturing 500 million of debt this year?
The likelihood at this stage is that we will probably do the refi in September of this year. But we've always followed a philosophy of having our debt split evenly over a 1-year, 3-year, and 5-year tranche. So obviously the shorter end of the tranche that has now expired, you'll see that our debt maturity is about 2.11 years and the hedge is slightly lower than that. Our anticipation is that that tranche will probably be refinanced at the 4 or 5-year mark post-September of this year, taking our average duration back to closer to 3 years, where we like it to be.
Thank you. Next question from Raghib Davids. What is the current run rate cash losses from hotel operations?
I quoted in the presentation, I don't know the exact breakdown of the hotels specifically, but the category related to hotels convention centre has impacted our assets by about 35 million rand this year.
Next question is from Nessie Chetty. Can you chat on your expectations on further asset impairments? Do you think the extent of write-downs reported cover the levels of rentals and vacancies potentially that will occur in the next 2 to 3 years? And the second follow-on part to that question is it becoming more difficult to maintain the underlying cost base relative to income given rising utility costs, municipal and other?
On the utility cost question, absolutely. It's an area that we are working with industry on and speaking to government on. What success we will ultimately achieve, we'll see. We continue to object to a lot of our municipal valuations, and a lot of our Joburg assets are in process now where they are going to valuation appeal board hearings over the course of the next couple of months. In terms of our valuations going forward, I think what we have experienced in the last quarter of last year has been better than what we expected at the second quarter of last year as far as these assets are concerned. I think our valuations are transparent. There has been more conservatism around growth rates, what you assume to be rental levels for certain categories of tenant, and how long it takes you to fill vacant space and space that you expect to fill up during the course of the forecast period. What we have also seen is obviously in this environment there's a lot of uncertainty. You couldn't really predict how tenants were going to trade in the middle of last year compared to now, and a lot of uncertainty still remains, and this impacted the valuations. But we still believe that these values are fair and transparent. Do we expect further deterioration? It's hard to say at this stage. If there is a third wave and more restrictive trading environments, those will have impact. But as bad as it's been over the last, call it 8 to 10 months, we have seen some improvement in the latter half of that period, and we think, all things being equal, these valuations will be marginally where they are now going forward until we see an improvement or a further deterioration.
Thanks, Jose. The next question from Raghib Davids again. Are current levels of negative reversions in retail reflective of what you expect for future lease expiries?
As I noted in the presentation, the negative reversions that we experienced were only for 3.5% of the portfolio, or 3.6%. That doesn't give an indication as to where levels are going to settle in 2021. However, our strategy is to create a sustainable rental base going forward. The most important strategy for us is to make sure that we keep the tenants in our malls and we help them through this period where they get their trade back up to where it was. It's a careful balance between getting the right rental level in place and sharing some risk with the tenant on the upside. So we look at the way we structure our leases differently. We look at doing what is best for the center and making sure that we help tenants to get through the difficult periods, and then they will help us again with maybe perhaps paying some higher turnover rentals or taking a longer lease in cases where the recovery occurs. We did budget into 2021 for negative reversions. As I said, we remain realistic and don't think all of a sudden everything is going to turn around and we're going to see positive increases again going forward. Inflation is at 3.5%, and we have to keep that in mind where our lease escalation sits at around 70. So this is a balance that we work with every day and make sure that we deal with both sides of the coin in coming up with the right answer that can create a sustainable growth base for us going forward.
Thanks. Next question is from Mwesha Nene, also on valuations, but a slightly different angle. So, Amelia, I think your input would be good. The question is relative to what you see from your tenant affordability levels, with LTD having the highest retail rent per square meter on average. Do you see further valuation impairments on the back of expected rental declines, ignoring your view on cap rates?
Rental levels in the valuations of retail properties do not stand on their own. You also have to look at the trading density levels of our centers. Now, MSCI just last week brought out the latest December trading density numbers, and Sandton City's trading density remains 45% higher than the benchmark. Now, you have to look at the rental levels in together with the trading density numbers. You can't look at these things in isolation. So as Jose said earlier, we see the valuations being kind of staying at the level where they are this year, unless there is a significant deterioration in the market. It's uncertain what is going to happen. We don't exactly know. What we know is that we can continue to manage these malls in the best possible way. We look after the long-term sustainability by the ESG initiatives that we undertake, and we create an environment where tenants can trade. As long as we can continue to grow the turnover in our malls by bringing more people in and have them spend more, rental levels have to keep with that, and you can't just let the rental drop and not consider the turnover growth that we see.
Thanks. There are no other questions at this stage on the chat, so maybe we'll give people a last chance to submit questions. And in the meantime, I'll mention again that if you have additional questions, please feel free to send an email to investors@liberty2degrees.co.za and we'll respond to those questions. Okay, Amelia and Jose, I see no further questions on the chat, so I can hand back to you.
Thank you. Thank you, Gareth. Thank you for running with that for us. Thank you for attending today. We will be seeing most of you over the next week for one-on-one meetings, and looking forward to those engagements, and we'll continue to every day do the best as we can to drive the value of this portfolio. And thank you for being here today.
Thanks everyone. Keep well.